Welcome to The Explainer. Today, we're pulling back the curtain on the financial world to reveal, well, honestly, one of the biggest, most counterintuitive secrets of our modern economic system. We're talking about the absolute alchemy of modern banking. If you think you know exactly what happens to your money the second you hand it over to a bank teller, get ready to have your perspective totally shifted. We're going to look at how lending actually creates money. Let me hit you with a kind of shocking question right out of the gate. Do banks create money out of thin air? Now, I know legally creating money out of absolutely nothing sounds impossible, right? Maybe even a little illegal. But understanding the yes behind this exact question is the absolute key to understanding our entire modern economy. It's literally the hidden engine of finance. Okay, so let's dive right in and debunk a classic myth. When you deposit, say, $1,000 into your account, it's super common to imagine the bank taking that exact $1,000, walking it down to some giant, highly secure vault, and just locking it safely away until you need it back. But think about it. If banks just acted as free storage units, they wouldn't make any money. Banks are businesses. Their main goal? To generate a profit. So instead of letting your hard-earned cash just sit idle in the dark, they immediately put it to work. So here's how that core banking procedure actually goes down. Step 1, you make your deposit. Step 2, the bank doesn't lend out every single penny of it. They keep a small portion of it back, which is called a reserve. But then comes step 3, and this is the big one. They lend the rest of it out. They take your deposits and use them to provide loans to other people. Your money might literally be funding someone else's new car, or maybe a neighbor's small business, or even a student's college tuition. Let's actually put some real numbers to this so you can see how the cycle kicks off. Suppose you deposit that $1,000. The bank keeps its small reserve and then lends out, let's say, $900 to a borrower. Now that borrower has $900 to spend. They go out, they buy something, maybe a laptop for college. The person selling that laptop takes the $900 and deposits it into their own bank account, which could be at a totally different bank. So now, suddenly, that second bank has a brand new deposit of $900 to play with. And this perfectly illustrates the math behind what's known as the money multiplier effect. Just watch how these numbers snowball. We start with Bank 1 and your initial $1,000 deposit, right? The total money is $1,000. But then Bank 2 gets that $900 loan deposited. Boom. Suddenly, the total money in the system is $1,900. Bank 2 keeps a small reserve, then lends out $810. That gets deposited into Bank 3, pushing the total to over $2,700. As this lending and depositing loop repeats over and over, that single original $1,000 deposit can eventually support over $4,000 in total economic activity. It's wild. I really want to pause here and emphasize a totally crucial takeaway from all this. No new physical cash was printed. None. Yet the amount of money circulating in the economy just increased dramatically. Just think about the sheer scale of that money multiplier effect we just looked at. Thousands of dollars in economic activity were generated, and not a single paper bill had to come off a government printing press to make it happen. Now, hearing all that, I can practically hear the exact question forming in your head right now. Wait, is this magic? I mean, how can money just multiply without physical cash actually being created? It feels exactly like a magic trick, doesn't it? Well, the reality is it's not magic. It's just technology and accounting. You see, in today's digital economy, most money exists strictly as electronic entries and bank accounts. Banks aren't sitting there creating physical bills. When a bank approves a loan, they simply type numbers into a computer. They add digits to an account balance, and instantly, just like that, those digital digits are transformed into real spendable money for the borrower. Now, this brings us to the fundamental motive behind this entire multiplying system. Like, why do banks actually do this? Well, it's for the interest spread. By definition, the interest spread is simply the difference between what a bank earns by charging interest on the loans it gives out and what it pays out to you in interest on your deposits. This spread is the ultimate engine of profit. Let's contrast these two percentages so you can really see this profit margin starkly. Let's say a bank pays you 2% interest to keep your savings account with them. But then, as we just learned, they turn around, lend that money out to a borrower, and they charge that borrower 8% interest. That 6% difference right there, that is the interest spread. And it is exactly why banks are so incredibly motivated to keep your deposits moving and multiplying. It generates literally billions of dollars in pure profit for them every single year. But this also brings us to an inherent vulnerability in the whole system. Because banks lend out the vast majority of all deposits, they simply do not keep enough physical cash on hand to pay every single customer if everyone showed up at once. So, naturally, you gotta wonder, What happens if everyone tries to withdraw their money at the exact same time? When that happens, you get what's called a bank run. It's total panic. Customers basically rush the bank, simultaneously demanding their money, and they very quickly exploit the terrifying reality that the bank actually lacks the physical cash on hand to make everyone whole. If you've ever seen that old historical footage of massive crowds lining the streets outside locked bank doors, yeah, the panic it causes is very, very real, and it can collapse the entire system. So because of that severe risk, governments had to step in. They had to invent systemic safety nets just to maintain our confidence in banking. They created government deposit insurance, which means that even if a bank fails, your deposits are protected up to a certain amount. And they established central banks, which basically act as lenders of last resort to pump cash into the system during a major crisis. These safeguards are the only things preventing catastrophic bank runs from completely destroying the modern economy. So let's remind ourselves why all of this actually matters. Yes, I know it might sound like a wild, maybe even risky loophole, but this system of money creation is actually the really powerful, totally misunderstood engine that drives our world. By making loans, banks create new money in the form of bank deposits. And that new money is exactly what helps businesses grow, helps families buy homes, and allows entire economies to expand and thrive. To wrap up this explainer, I want to leave you with a final thought that completely upends that giant vault myth we started with. Ready? Money isn't just printed, it's created through lending. The vast majority of the money in your pocket, or, well, more likely on your screen, was literally willed into existence the exact moment someone, somewhere, took out a loan. And that brings us to the end of our journey today. Did this change the way you think about banks? Honestly, I really hope it did. I hope it sparked your curiosity and cemented a whole new understanding of how the mechanics of our financial world truly operate. Keep questioning, keep exploring, and we'll see you in the next explainer.